Good afternoon, ladies and gentlemen, and welcome to a very special edition of our Inroads to Relocation podcast. My name is Eric Delgado, Executive Vice President for Zippy Incorporated, based here in Washington, D.C. I'd like to welcome you guys today to a very special edition of this Inroads to Relocation podcast for a couple of reasons. Number one, this is our very first live podcast. So apologies in advance in case there are any errors, but hopefully there will not be. And number two, we're here with a really special guest, David Oltman, Chief Compliance Officer for Ineo Global Mobility. And he's here as probably one of the most sought after industry experts in something that's hitting the newspapers, hitting the media, and hitting our desks on a daily basis, the tax reform bill that's coming around the pike. David, thank you for joining us.
Thank you very much, Eric.
David, before we get into the tax reform bill, would you mind sharing a little bit about you, Ineo, and everything in between, please?
Sure. My background is I started in relocation about 25, 30 years ago. I was fortunate to work at one of the Fortune 500 companies called Novartis Corporation. And when I was there, I was in the Global Human Resource Department. And my job, I was director of both domestic and international relocation. While at Ciba-Geigy, one of the things I enjoyed the most was the compliance aspect of relocation, all the various tax issues, but I also enjoyed the technology aspects too. So I actually developed a program there called GROSSUP, GROSSUP. And because I just love that word GROSSUP, for the past 30 years, my license plate on my car is actually GROSSUP, GROSSUP. Nice. When I drove to the airport today to come down to Washington, the car I drove to the airport has GROSSUP on its license plate. But again, starting at a big company like a Ciba-Geigy Corporation or Novartis Corporation, being involved in technology and tax, that's how I got involved in both corporate and government relocation.
Great. That's interesting. That's a good little piece of tidbit from you. Thank you for joining us here in DC.
Thank you.
I know for a fact that we weren't the only reason why you're here today. I believe you're spending 48 hours in the DC area. This is where all the action is happening. This is where the tax reform bill is being created and discussed and talked about. What else do you have on your agenda while you're here?
Sure. I'm fortunate. We've got a lot of clients in the DC area, so I'll be meeting with some of them. I've got a meeting later today at the Pentagon. Tomorrow I'm meeting with the Greater Washington Employee Relocation Council. It's referred to as the GWERC. And the meeting is at the OCC, the Office of the Comptroller of the Currency, and that's happening tomorrow from 9 a.m. to 1 p.m.
Nice, great. So you have a busy schedule.
Yes.
Before we get into the tax reform bill and how it impacts mobility, you're seeing it everywhere. I mean, everywhere you turn, Wall Street Journal, the New York Times, the Washington Post, CNBC, Fox Business, the list can go on and on. One of the main topics of discussion is this tax reform bill. Why are people so interested in this bill, and what are the main talking points that people are actually focusing on right now as being key impactful issues that are arising?
The main impacts of the bill is currently today we have 7 different tax brackets. Under one of the proposals, be it the House or the Senate, there may only be 4 brackets. Under another proposal, there may be 7 brackets. The good news is, generally speaking, the rates are going to be a little bit lower. So that's one of the good things. Generally speaking, the rates should be a little lower. The second major issue is alternative minimum tax. So many Americans are affected by AMT. So many relocated employees are affected by AMT. They're talking about eliminating that, so that could be a good thing. On the other hand, as we speak today, on Tuesday, they're negotiating it, they're reconciling it, the House and the Senate version. They're trying to come to an agreement on what's the best way to go, and we're not quite sure if the AMT is going to be in or out. But what we do know is most likely the phase out for certain itemized deductions and exemptions, those will be done away with, which is a very good thing. It looks like they're going to increase the child tax credit, which is a fantastic thing. Right now, today, if you have any children under the age of 17 living with you, and your adjusted gross income is under $110,000, you get a $1,000 credit per child. Under some of the new bills that are proposed, they're talking about maybe a $1,600 credit per child, maybe up to $2,000 per child, but it won't be phased out till your income hits $230,000. So it means more people are going to take advantage of this great new child tax credit, and more people are even going to get more money, because obviously 1,600 is a lot more than 1,000, and if it goes up to 2,000 per child, that would just be fantastic.
It's interesting. So today, we're sitting here in our offices. You're going to be meeting with a lot of your clients that are all in mobility. Let's talk a little bit about mobility now. Let's not talk a little bit, let's talk a lot of it about mobility. Um, Unfortunately for the mobility community, we're not, when I'm talking again about those newspapers, the Times, the Post, the CNBCs, the media, the magazines, and I'm hearing them and I'm reading them. I very rarely see anything that says, "Oh, in global mobility news," right? We don't get the headlines, right? But you and I are going to be impacted, so are a lot of people who are on right now, by whatever's happening and the impacts directly pertaining to mobility. What are the top impacts? What's going to happen in your opinion?
Our industry literally is going to be turned upside down. The effects are so significant. For literally the last 20 years, if you met what was called a 50-mile test, if you met what was called a 1-year rule, you were able to fill out IRS Form 3903 and deduct your moving expenses. Every dollar that you spent with a household goods carrier, every dollar that you typically spent for a final move was totally tax deductible, a really, really good thing, and it's been that way for over 20 years. If this tax bill passes, effective 1/1/2018, the 50-mile rule goes away, the 1-year goes away, and IRS Form 3903 goes away. In essence, no moving expenses are going to be deductible whatsoever. What that means, because now you can no longer deduct those expenses, it means that companies are going to have to acknowledge that. And when they transfer individuals, those employees are going to have a significant tax increase. Their tax burden is going to go up well over 50%. So now most companies will either gross up or tax assist those transferees because they can no longer deduct their household goods or final move costs. And that's a significant new expense to both corporate America and the government.
Okay, so you said a lot there, and it sounds as though there will be a new norm. What is that new norm going to look like? How should we prepare? Because when you say things like it's going to turn the industry upside down, it makes me nervous. I'm sure it makes a lot of people nervous. But in life and in business and in taxes and in government, things change. So what's the approach? How are you counseling people to be prepared or get ready for this new norm?
Sure. The first thing is because today is December 12th. We still have roughly 18 more days left in the end of the year, 19, depending on how you want to count it. And if companies accrue for their moves between now and the end of the year by 12/31/2017, if they accrue for their moving expenses, even though they're going to get an invoice from a household goods carrier in January or February or March of next year, because it was accrued for and the expense was actually incurred, the van line pulled up, packed the goods, unpacked the goods, did all that in December by 12/31, those can still be treated as tax deductible, no gross up needed whatsoever. However, if a company doesn't accrue for those expenses and those bills come in January, February, or March of next year, even though the moves happened in December, but because no accrual was done, they're all going to be taxable and they're going to have to be grossed up. Several companies literally spend millions of dollars in van line charges and final move costs between November and December, just at the end of the year. Those couple $1 million, because the average gross up percent is around 65%. If you took 65% of $2 million, that's over 1.3 million. So by a company simply accruing, listening in today on either Facebook or YouTube to this webcast, by a company simply accruing for expenses, they can literally save $1.3 million in gross ups. It saves their company money. It saves the employee the burden of having to file their tax returns different ways. Accrual, accrual, accrual. That is the message between today and 12/31/2017.
So accrual is the message. That's point number one. So for you folks out there right now listening, this is some great piece of information. If I'm sitting at an RMC right now, and I'm an RMC and I've got a nice portfolio of clients, am I speaking to them about the accrual? Am I reaching out to you to talk to them about who's connecting the dots right now?
Absolutely. If you're at an RMC right now, you should be contacting every single one of your clients and make sure they accrue. If you're at a household goods carrier, typically referred to as an HHG, a van line, a moving company, You should be contacting all of your clients right now saying, if you can get this move started and completed before the end of the year, you can literally save tens of thousands, if not millions of dollars in extra gross up costs. So that is absolutely a very big message that needs to be delivered between now and the end of the year.
Wonderful. Okay, so the end of the year ends, and people have already done all their bookkeeping and their accruals and what have you. I'm in 2018. As they say, the show must go on. How's that show going on?
Sure. In 2018, every company listening in today to this webcast will need to change their policies, and they'll need to change their budgets. They're going to have to budget more money in 2018 because an average move that cost you $100,000 in 2017 is going to probably cost you $110,000 or $115,000 in 2018. So at a minimum, you've got to change your budget. The second item you have to do is update your policy. And the reason you need to update your policy is in both proposals on the tax reform, be it the House proposal or the Senate proposal, there's this thing called the child tax credit. And today, the child tax credit gets phased out as your income hits $110,000. Many corporate transferees and government transferees between the employee's income, their spouse's income, and the moving expenses, they're way over $110,000. So the child tax credit was something they really didn't pay too much attention to. It was $1,000 per child for kids under 17, but because they made over 110, they really didn't focus on it. But now, under these new bills coming out, the child tax credit may be $1,600 per child under 17 or $2,000, and it won't even begin to phase out to maybe $230,000. So now a significant majority of both corporate and government transferees make way under $230,000. So the good news is they're going to be eligible for this credit. So if you've got 3 kids, you're talking about maybe a $5,000 credit. This is why you want tax reform to pass, because you've got 3 kids at home who are under the age of 17, and you know you and your spouse don't make anywhere near $230,000. You're excited. You want tax reform because you want that $5,000 child tax credit. However, if you take your salary that you earn with the company or the government, take your spouse's salary, and now add on an additional $50,000, $60,000, $70,000, $80,000 of taxable moving expenses, you've pushed them over that $230,000 threshold, and they lose that child tax credit. So just because you moved them in 2018, they're going to lose a $5,000 credit right in their pocket. So companies need to adjust their policies to decide, how are we going to deal with this? Are we going to reimburse our employees for that $5,000 loss or not? And how are we going to do it? Are we going to take their words? Are they going to have to submit their tax return? Maybe your policy is, we don't want to look at your tax return. Maybe you'll need to hire a third party. This is a huge issue that's brand new in 2018, all because of tax reform.
What steps are people taking? I mean, it's one of those situations that I feel, and I spend a lot of time talking to our clients, that we're just so busy. We're still busy from 2017 that we barely get the ability to take a breath of air. Now is a new, brand new landscape that we're playing on. What steps should, if you've already reached out to your current portfolio of clients, if you've already talked about what this means for you in 2017 going into 2018, if you looked at your policies and counseled your clients, what else do you need to be doing? Do you need to be looking at third parties to help put this all together? Can you do it internally? Is it overly complicated or not complicated, or what should people be doing there?
Actually, it's extremely complicated, and it's all about compliance. So the companies and the government agencies should absolutely be reaching out to their RMC, their relocation management company. They need to get their help because that employee does need to be counseled. Anytime any employee is notified that they're going to move, typically most companies offer what's called a tax consulting hour for understanding their policy better with the RMC. Now more than ever, they need to have that conversation so the employee can plan and budget. My personal email address at ineomobility.com has been going off the hook by transferees that have gotten wind of these new policies and their concerns that if tax reform passes, that their company's policy today does not take into consideration that loss of that child tax credit. So people have been calling me, people have been emailing me saying, what can I do? How can I get my company to focus on this new policy? Because I'm concerned I'm not going to be the benefactor of tax reform. So companies really need to work with their RMCs, work with their tax providers to get all this information together.
Earlier, you've mentioned you've been in one way, shape, or form associated in tax and numbers and in making sure people are being compliant. We're going to be okay, right?
And the reason we're going to be okay, and here's why. According to the Employee Relocation Council, the average cost to move someone, if they're a homeowner, tends to be $80,000, $90,000, $100,000. So if the average van line bill is approximately $15,000, and we know the average gross up based on the new 2018 law is maybe an extra $7,000 to $10,000, we can say comfortably the average cost increase to both the government and corporate America is about a 10% increase. While I don't want to minimize what 10% is or maybe 15%, I think companies can handle it. It's definitely more money. A 10 to 15% is a significant number, but it can be handled. Where companies really need to plan is who gets that 10%.
Right.
It's all about equity. If you move 100 people, you want to make sure 30 of those 100 who need the money get it, and the other 70 that don't really need it don't get it. So that'll be the challenge for corporate American government agencies, is making sure under the new tax reform bill, the people who really need the extra gross up dollars are the people who are really getting it.
Right. So we're going to go to some questions. We've had some really good questions pop through. And I'm just going to go here, pick this one up. There we go. We've got some already questions that came in earlier. Here's one. In terms of 2017, 2018, you mentioned the accrual. So basically, I can't invoice and collect in 2017 and reap the benefits of that if my transferee is moving in 2018. Is that correct?
That is correct. Simply stated, the new tax bill, the new tax reform bills, and all the proposals affect 2018. There's really no effect in 2017. I'm oversimplifying it, but basically for 2017, it's the same as you did it last year. Everything we're really talking about today, it's all about 2018.
How do you see reporting being impacted by this? I mean, is that going to be something? Are there mechanisms to make sure the reporting is clear and concise? Are you going to be able, or people in the RMC will going to be able to give reports out properly with what they currently have out of the box on their technology? How's reporting going to play into all this?
Eric, I'm so glad you asked that question, because reporting changes so significantly. It's an understatement to just use the word significant. The reason reporting changes today and for the last 20 years, if you paid a household goods move or a final bill, and that was paid directly to the employee, it went right on the W-2 with the code P in box 12. Under the new bill, it doesn't go to the W-2 whatsoever. So for the last 20 years, payroll departments, human resource departments have been tracking expenses a certain way, so they'd go in certain box numbers on everybody's W-2. Under the new bill, they don't go on the W-2 whatsoever. So companies need to change their systems to handle these new compliance requirements.
Sounds like a lot of work.
Yeah.
Lump sums. How does this bill impact lump sum moving?
In one way, it actually enhances lump sums. Today, in the last 20 years, lump sums were always a little bit hard to calculate, because you had to figure how much of the lump sum was taxable and how much was not taxable. In 2018, it's all taxable. So in one regard, it's actually easier to issue lump sums in 2018 because you don't have to worry about trying to figure out what's taxable and what's not. It's all taxable, and companies need to decide, should we gross up the lump sum or should we not? That's one of the things that I love about government and corporate relocation. Part of the job is compliance. That's the law. You have to do it. The other part of the job is policy. You can do whatever your company wants to do, which is what I love. It's always a balance between compliance and policy.
Wonderful. We've got a couple of questions before we start wrapping this up. Will this slow down the relocations across the board?
Eric, as they say, time will tell. My gut reaction is no, a company's not going to move a person because it's going to cost 10 to 15% more next year. So my gut tells me no, but as we say, time will tell.
The counterpunch, right? I'm just being devil's advocate. Apparently, the corporate tax rate will go what? Down. So if I'm going down here and I'm coming a little bit up here, would that be a wash maybe?
And that's a great question. In fact, it's been quoted in many national sources that this new tax bill because it is going to lower the corporate rate. And the good news is, in 2018, yes, your gross ups are going to go up, and yes, your cost to move somebody may go up 10%, 15%. That's still a tax deduction that the company gets. Mm-hmm. And as you mentioned, because the corporate tax rate is going to go down, it may be, I hate to say it's going to be a wash because the relocation is not the biggest piece of the corporate pie in determining what's profitable or not, but it's definitely, it's something to look at, something that needs analysis.
Great. Will companies look for lower cost providers in relocation?
I think companies are always looking for best and most common practices, the best RMCs, the best providers. Cost is always an issue. And now, because costs are going to be increasing 10 to 15%, I think companies will be even more focused on costs moving forward. So I would say yes to that question.
And then I've got one more question, unless anybody out there wants to chime in. Isn't this like increasing the cost of relocation by 65%?
Where 65% comes in is the average van line bill, if it's $15,000, you can estimate about 65 to 70% of that is now going to be taxable. So if a van line bill is $15,000 and you take 60 or 70% of that, that's probably an extra $7,000 or $8,000. So that move, while the total move cost $100,000, you're adding $7,000 to $8,000 in the gross up. So the average gross up percent is 65 to 70%. The average van line bill may be $15,000, but if we look at the total cost of a move, roughly $90,000 to $100,000, that's the 10 to 15% increase.
David, what can I say? This was great. Ladies and gentlemen, thank you for participating and being part of our very first ever Facebook Live, YouTube Live. This was a wonderful interview. For those of you who haven't seen our podcasts, you can catch up on some of our old podcasts that talks about a lot of really interesting things pertaining to mobility. You can always check out www.zippyshell.com/relocation/media for more episodes of our Inroads to Relo podcasts. Otherwise, have a great day.
Thank you very much.
Thank you, David.